Hi, I'm the hamster narrator, and today I'm counting AI-like sunflower seeds. In just 3 years, so many seeds were poured into AI data centers, chips, and energy that people compared it to the cost of building the US interstate highway system over decades. And here's the paradox. The Gen AI Divide report and the discussions around it say that 95% of companies still haven't gotten any measurable financial return from Gen AI. The seeds are already spent, but for many, the profit bowl is still empty. Here's one more number to feel the scale. The IEA expects data center electricity use could double by 2030 to about 945 terawatt hours. Robo-hamsters are smart, but the planet's outlet isn't infinite. From here, no panic. AI is a real technology. It's just that expectations around it often inflate. I'm going to separate useful from expensive and risky, the way a hamster separates seeds from shells. The word bubble means one thing. Prices and plans grow faster than profits in real financial reports. The bubble can pop, and the technology can still remain. I watch three things: who pays, how much energy it needs, and what real value it creates. If even one point is weak, the seeds start spinning in circles. Remember this picture. A circle of seeds is when money moves between giants and creates the illusion of growth. Now let's break that circle down into arrows. Imagine three giant hamsters: chips, cloud, and an AI startup. The startup gets investment seeds and immediately spends them on chips and cloud. In a Microsoft post, it's stated plainly. The OpenAI API is exclusive to Azure and runs on Azure. That's convenient, but it ties the seed money and the computing barn even tighter into one place. Reuters reported that NVIDIA was preparing to invest huge sums into OpenAI while also remaining a key chip supplier. When the investor and the seller wear the same fur, the circle gets tighter. Reuters also reported that Oracle planned to buy about $40 billion worth of NVIDIA chips and lease capacity to OpenAI through a long contract. That's like building a barn for one tenant, and the risk concentrates. Bloomberg called this circular deals, when deals prop each other up the way hamsters brace a wall with their shoulders. It's not necessarily fraud, but the demand picture gets murkier. Here's a simple test. At the end of the chain, there must be an ordinary customer paying for real value. If the chain ends with an investor again, it's a circle, and circles like to pop. JP Morgan wrote that in the first half of 2025, AI capex added about 1.1 percentage points to the GDP growth rate. That's a lot, but it's important to remember it's a contribution to growth, not all of GDP. At the same time, economist Jason Furman estimated that investments in data centers and information equipment delivered the lion's share of growth in H1 2025, and the approximately 92% figure spread widely in summaries. That's an estimate based on investment categories, not an official AI button in the statistics. The meaning is simple. If the barn building slows down, growth rates can get quieter too. That's why markets watch every new data center so nervously. According to the European Commission citing the IEA, data centers now use about 1.5% of global electricity, roughly 415 terawatt hours. And the forecast is growth to about 945 terawatt hours by 2030, more than doubling. Even if models become perfect, wires and substations don't grow overnight. That's why AI builders increasingly invest not only in servers, but in energy too. CBRE wrote that data center vacancy in key North American markets fell to about 1.6%. That means there's almost no free rack space left, and everyone is booking ahead. JLL separately cited about 2.3%, and the phrase, power is the new real estate. First, you need electricity, and only then do the barn walls matter. JLL also writes that the average wait for grid connection in major markets now exceeds 4 years. You can build the barn quickly, but the outlet often arrives last. That's why I call it a physical wall. Money can run faster than infrastructure. And if the wall doesn't move, business plans start to crack. The Washington Post wrote in January 2026 that since February 2020, U.S. electricity prices rose by about 40% on average, and in some places nearly doubled. At the same time, data centers sometimes have different tariffs because they connect to high-voltage lines. Reuters and the FT wrote that politicians in regions like PJM are already discussing how to make data centers pay more for grid expansion. It's a conflict between ordinary hamsters and giant consumers in the same electricity barn. For us, the takeaway is simple. Energy is becoming part of AI's cost base, just like chips. If electricity gets more expensive, the profit seeds melt faster. Another risk is concentration. The Magnificent Seven make up roughly 34% of the S&P 500's weight as of January 2026 estimates. If investors reprice the AI story, the whole index barn can shake. That doesn't mean everything crashes. It means the swings get higher. When giant hamsters sit on the roof, the small hamsters below feel more fear. That's why I always look at where profits are, where the debt is, and where the energy costs sit. The market can tolerate losses for a long time, but not forever. In 2025, layoffs.fyi shows 123,941 tech company layoffs, and Challenger separately counts 154,445 cuts in the technology sector. The methods differ, but the direction is the same. Companies are reshuffling staff around AI, and often AI doesn't replace people. It adds work, checking, fixing, and controlling robo-hamster mistakes. I call it the AI janitor job because someone has to sweep up the digital shells. In reports, that cleanup often hides as a quiet fee of time and money. That's why pilots can look beautiful while the P&L doesn't. The Washington Post uploaded a fake video made with Sora to 8 social platforms, and only YouTube clearly indicated it was synthetic. If labeling doesn't work, trust in video drops like a sack of seeds into water. The danger isn't one fake, it's a new reflex. Anything could be staged. And in that world, truth doesn't win. Whoever spreads louder and faster does. That's why source checking becomes a new kind of financial hygiene, like not carrying seeds in a leaky bag. The more AI content there is, the more expensive verification becomes. This situation echoes the dot-com era. The technology was real, but many valuations were too sweet. One analyst even called today's wave many times bigger than dot-com by capital scale. An opinion, not a law of nature. Another analogy is railroads. The infrastructure was needed, but many investors lost money because they overestimated how fast profits would arrive. AI may become the rails, but not every ticket will pay off. This isn't the end of AI. It's a lesson about expectations. Don't confuse "it will be useful" with "every bet will be profitable." My 5-question checklist. Where's the profit in the P&L? Who pays at the end of the chain? What does energy cost? Is there power and space? And how much cleanup comes after AI? If the answers are strong, it's a tool, not a bubble. If the answers are weak, the seeds go into concrete and wires, and investors are left with a pretty story. Stories keep you warm, but the electricity bill is paid with real money. I'm a hamster, and I'm for AI that truly helps, not AI that just shines loudly. Protect your seeds, check the numbers, and don't take bubbles at their word.